Please keep in mind that this presentation is being recorded. Good morning, everyone, and welcome to the Ortencio Group January 2017 Market Outlook. As always, I have with me Gareth Watson, Director of the Investment Management Group at Richardson GMP. I want to take this moment to wish everyone a Happy New Year, and hopefully you enjoyed the holiday season with your family and friends. Before I hand it over to Gareth, I wanted to recap 2016. In 2016, we saw a reversal in some of the major markets. The TSX went from worst to first with a 17.5% return in 2016 versus an 11.1 negative return in 2015. The U.S. market was a bit more subdued, but still provided 9.5% return. For Canadian investors, they provided an 8.9% return, with the Canadian dollar actually gaining ground at the end of the year, with the U.S. dollar ending the year at $1.3441 versus the loonie, compared to the year before, December, where it was at $1.39. The international markets, or index, measured by the MSCI Europe, Australasia, Far East Index, continued to struggle with a negative 1.9% return in 2016. And again, for Canadian investors, it was actually down 4.6 because of the strength of the Canadian dollar. Oil had a really strong rebound last year with a 45% return, going from $36.60 a barrel and ending at $53.72. This was a major contributor to the Canadian market, along with the strong performance of the Canadian financials. Last year, we saw bond yields, or interest rates, finally go up, both on the short-term and the long-term bonds. The U.S. Feds increased the short-term overnight rates by 25 basis points, or 0.25% in December. And the projection is possibly more increases in 2017. Garrett's going to be discussing this in a bit more detail shortly. The 10-year government rate in Canada saw an increase in yields from 1.39 up to a close at the end of the year to 1.72. In the U.S., we saw it go from 2.27 to 2.44%. So that's pretty much a recap of the economic numbers in 2016. Last year, the major news headlines was the surprise result, first of all, by the British referendum that resulted in the vote for Britain to exit the European Union, now infamously known as Brexit. This rattled the markets for a couple of days, and then global markets recovered as if nothing happened. The biggest effect was on the British pound, that experienced record declines and still hovering at those low levels. And of course, the biggest newsmaker globally was the election of the reality TV star billionaire Donald Trump to the White House as the 45th President of the United States. It was anticipated that if the polarizing Trump was elected, that it would drive the markets down 10 to 20%. In the end, Trump's Make America Great mantra converted actually into a Trump rally for global markets. A bit more closer to home, the Canadian real estate market continued its trajectory upwards and onwards. Rule changes provincially were being implemented to slow the values from continuing to rise. And we saw this in British Columbia regarding foreign owners, but in Ontario specifically, in Toronto and the 905 suburbs, prices and home sales continued to soar. After that recap, I now want to hand it over to Gareth, the call over to Gareth, to discuss what these events could mean in 2017, along with some of the major themes for the upcoming year. So, Gareth, the presentation is all yours.
Thank you very much, Frank. Just want to confirm you can hear me, correct?
I can.
Excellent. Okay, so with respect to today's presentation, I will be going through it fairly quickly. I don't want to take up too much of your time because this presentation actually can usually go on for about 45 minutes, but I'm going to try and do a condensed version. And certainly if you have any questions about anything that I mentioned here, by all means, please don't hesitate to reach out to Frank. We can certainly get you some answers. But I just wanted to cover off some general views. And the format of my presentations, if you've joined us before, it's always the same. Just going to go through a few of the themes, touch on, of course, the United States and Canada, a little bit of overseas with respect to the UK and Europe, and then kind of tie it back to Canadian markets. So in terms of the themes for 2017, I'll just first of all start off by saying that there's a lot of economic data out there that is relatively positive. And it's not just coming out of the United States. It's actually coming out of a number of different places around the world. The Citigroup Economic Surprise Indicator in the indices, of which there are a number for various countries and regions, as of right now, for most of the world's major markets, they're all in positive territory, and it's very rare to see all areas of the world with those indices in positive territory at the same time. So that's encouraging. That just means, now it's not to say that everything's great and rosy and nothing can go wrong. It just means that relative to expectations, economies are actually performing better than expected. That can always change, but for the time being, it's in a positive position. So that bodes well, obviously, for the global economy, but also for markets. We have been in the midst recently of an earnings recession in the United States and Canada. That essentially came to an end with the last quarter, namely because we're finally getting rid of the downside comparables of the oil and gas sector in both countries. Obviously, they were hit hard, particularly last year. Many of you will recall the decline at or I should call it the material decline at the beginning of 2016 in oil prices down to the low mid-20s level. That took a severe toll on earnings in the oil patch, and it's not as if they've rebounded completely at all, but they are certainly looking better today than they did a year ago. So the comparables are better, the earnings growth is there, and of course, when you can come out of an earnings recession, that's usually good for equity valuations. We will always talk about monetary policy. That will never go away. The Federal Reserve will continue to be the topic of the day. When it comes to monetary policy, as Frank mentioned, there's a very strong likelihood you will see rates go higher in the States this year. Then again, we did say that at the beginning of last year. I should say the street said that at the beginning of last year, and it didn't necessarily materialize as expected. However, even though the Fed will still be under the microscope, there is more and more discussion now about fiscal policy, or in other words, government spending, as being a method of stimulus for various economies. And it's very interesting that Canada used to be held with great regard as to how we were trying our very best under Jim Flaherty and the old Conservative government to balance the budget during a very difficult time, while a lot of other countries were not doing well, fiscally speaking. But it is, in fact, Canada that seems to have led off this wave of increased fiscal spending with the new Trudeau government. It is now a model that appears to be popular and is being followed in a number of other places around the world. At least calls for it to be followed are popping up in a number of places around the world. And Donald Trump, quite frankly, if you want to look at, what's the differences and similarities between Trudeau and Trump, some people would say, well, there can't be any similarities. Well, there actually are. Both appeal to the middle class in their campaigns, and both want to spend. So fiscal spending, I think you're going to hear a whole lot more about this in this year. Also because, of course, we do have some significant elections going on in Europe, and usually fiscal spending is one of those tools, election tools, that that people that compete in those elections use to try and win over voters. Now, with respect to Canada, I wouldn't say that we are looking for a remarkable year. It could be a fairly neutral year. There still are a number of challenges, which I'll get to later in the presentation. But one thing that I think differs from the past couple of years is that I don't think we're going to see a great deal of volatility in the loonie. The past couple of years, we have seen certainly some downward pressure. Last year, we saw some significant downward pressure at the beginning of the year with some very bearish calls being made, only to see the loonie rebound all the way up to 80 cents. So again, significant volatility in our currency. I'm not sure if we're going to see a repeat of that this year, and I'll get to that, of course, in the last slide when I talk about the Canadian dollar. And the nice thing here about oil prices, they might not be $100 a barrel, especially if you live in Calgary. That's something that you'd love to see. But at the same time, we do have some stability over the past 6 months for once. We're not talking about whether the price is going to move $20, $30, $40 a barrel in a very short period of time like we were experiencing at the beginning of last year. It appears as though we do have some stability considering what's been going on here with OPEC and with non-OPEC nations with respect to supply. But I'll get to that a little bit later as well. But I just want to touch on these themes that I'll talk about for the rest of this presentation. So monetary policy, this slide will be very brief because, well, there's really not a lot of information on it that's revealing to you here. The one thing, of course, is the United States. The expectation at this stage, and this will change probably during the year, and I'll probably bring it up in future calls, but for now, economists appear to believe that the Federal Reserve will raise rates twice in 2017. Give or take, it could be 1, it could be 3, it could be 4. Point being is that the bias is higher. So we finally moved rates in December of 2015. We finally got that second increase in December of 2016. The hope is that we don't have to wait till December 2017 for the next one. It's a good thing that these rates are going up. It means that things are at least showing some sign of going back to normal, and a lot of people will actually forget what normal is now because we've had zero interest rate policies for so long. There are people with careers in the capital markets that have no idea what working in a marketplace with higher than zero interest rates is like. So this is an encouraging sign as far as I'm concerned. It will obviously cause some volatility potentially down the road in the marketplace, but it is a necessary evil to get the Americans back on firm standing. The rest of these areas of the world, we're not expecting many changes in interest rates. That could change maybe in the United Kingdom, and a very, very small possibility maybe in Canada where you could see a hike, but I doubt it in our country. The UK maybe, depending on what happens with Brexit negotiations. I think that's the thing holding things back right now in the UK. Japan and Europe, we don't expect to see any increases at all because they still have significant quantitative easing programs that need to kind of come off first before you start raising rates. So the United States here, let's talk a little bit about what we're seeing south of the border, because there's a lot of question marks, obviously, with Donald Trump coming to the presidency on Friday. First of all, I will say that the economic data is still relatively positive. When you look at employment, when you look at inflation, as I mentioned there, employment data is still very supportive. You have a very low unemployment rate. It's interesting that Trump notes he's going to be the greatest jobs-creating president ever. I think it's going to be tough for him to do it, considering the unemployment rate's so low. Now, there's some people who will say, look, that rate is so low because a lot of people left the workforce and they're not being counted, and Trump's going to bring those people back into the workforce. It's quite possible. But there's going to be some areas where he's going to have trouble creating jobs, and I'll get to that a little bit later. Now, I think the biggest question mark, of course, has to do with what his policies will be. And there is certainly a possibility that in the near term, we could see growth in the U.S. economy simply from those policies, depending on how big they are, what they are, and the magnitude of them. And that has to do with fiscal spending, which of course is government spending, which Donald Trump wants to do a lot of. His colleagues in the Republican Party might not necessarily agree as much with that. The Tea Partiers are big fiscal conservatives that don't like deficits, so he's going to have, I think, some fights with his own party on that one. Tax cuts, the extent of them in terms of what we get, obviously repatriation of money offshore back into the U.S. economy, and trade. Trade's going to be very interesting to see what his take is. There are some people worried in Canada about what his take will be on the North American Free Trade Agreement. I'm not overly concerned just yet about it, only because Canada is not the target of his frustration. I don't think I need to tell you that Mexico is, and I don't think I need to tell you that China is. The fact of the matter isn't it simple. I don't think Donald Trump has said the word Canada in the past 18 months that he's been running for the leadership and then for the presidency, and I think that is a phenomenal thing, because if he's not talking about you, it means that he actually doesn't have a problem with you. So from a Canadian trade perspective, you know, I'm not as concerned as some about the consequences of any Trump trade policies. And to some degree, and this is maybe looking a little bit too optimistically at Trump and trade, but he actually could be doing some heavy lifting for us Canadians, because I'm sure there's some Canadians that have a bit of a problem with jobs going south to Mexico, and certainly the auto industry is an example of that. He might actually be doing all the fighting for us. So I wouldn't necessarily say that revisiting NAFTA is an absolutely horrible thing for Canada. There may be some negatives to it for sure, but there also could be some positives. So I think we have to take that one with a grain of salt. Now, I did mention here in the last bullet point that it is likely, we are in the 8th year of the economic expansion in the United States. Expansions normally don't go this long, historically speaking. Usually they're 4 or 5 years. We're in the 8th year. So to suggest that we can go through 12 years without a recession, I can't say with 100% certainty that that's impossible, but it's also unlikely. So even though you can see a bit of a lift because of any policies that he puts into place in the first couple of years, the last couple of years might be a little bit more tricky for him to keep up that sustainable growth. And as such, you might see some form of contraction in the latter half of his first term. Of course, perfect timing for the next election. Likely he will defer and say it's Obama's fault. But point being, he is going to face some economic headwinds at some point during his term. Now, I believe I've covered this off in a previous call. I think we had a call following the election, just in terms of the implications. So I won't spend too much time on this slide, but there are some positive things about Trump in terms of what he has said during the campaign with respect to the markets and to the U.S. economy. Tax relief, and all these things are taken from the perspective of the stock market. So some of these things you might not agree with personally, but they are things that the market views as positive. So of course, tax relief, both personal and corporate. You're putting more money into the hands of consumers, the market's like that. You're putting more money into the hands of corporations, obviously earnings like that, which then helps valuations. Corporate tax amnesty, if you have cash offshore, you're not bringing it home because it's going to be taxed. He's going to try and do something to make sure that cash comes home, maybe a small penalty, or bring it back tax-free. Again, more money in the hands of corporations. They like that. Corporations love less regulation. You as an individual may think there needs to be more regulation, but corporations disagree with you. They like it, therefore markets like it. Increased fiscal spending, where's that money going? It's probably going to companies that are listed on a stock exchange. Corporations like that policy. And so these are all things that are good for corporate America. This is why I think the markets have held up very well since he was elected, as opposed to tanking, which was one of the original predictions, just because he's Trump. And there were so many question marks about who he is and what he's going to do. But it's also not smooth sailing for Trump the whole way. These are things he has to contend with. Rising interest rates is going to be a big deal. He wants to spend a lot of money on fiscal spending. Well, you have to obviously raise that money in the bond market to spend it. And if rates are going to go higher, it's going to be more expensive to borrow. And so that's going to be something he has to take into consideration. I've already mentioned, are we going to see the next recession? Possibly in the next 4 years. Maybe not the next 2, but the next 4 is a possibility, so he's going to have to deal with that. The whole trade question mark is going to unravel here in the next year. How will that affect the U.S., but also how will it affect global growth? What type of responses do we see to the Trump policies? That is also unknown. Immigration policies, I really don't know what he's going to do. I do know that he can't, I don't even think it's humanly possible to physically kick out 11 million illegal immigrants. The amount of resources and manpower that would take, I just don't know if that's even humanly possible in 4 years. But if he is successful in at least deporting some of them, there will be economic consequences, because those are people that are working at a wage below which the average American is willing to work for. And so what happens to those jobs, and what happens to the businesses that employ those workers? It's not going to be smooth sailing there. And keeping his promises to the Rust Belt, this is the area of the United States, I'm thinking of Wisconsin, Michigan, Pennsylvania, Ohio. A lot of those states were supposed to go Democrat. They went Republican, supposedly fed up with the way things were, think that they have been forgotten. We're talking about coal jobs. We're talking about steel jobs. We're talking about manufacturing jobs. Trump has said he'll bring them back. A lot of people have argued he can't, because they weren't disappearing simply because they were going to China. They were disappearing because of things such as automation, because the world is moving away from coal and moving to other sources of energy. I'm really going to be curious to see what happens 4 years from now, how successful he's been to job creation in that part of the world, because if he doesn't come through on this, those states could easily go back to the Democratic Party. They have bought what he is selling, and now he actually has to come through. So I think he's going to have a really tricky job in those parts of the United States creating jobs. As I flip over here to the United Kingdom, the European Union, it's going to have a magnifying glass on it this year, not just because of the ongoing situation with Brexit, but because we do have 2 federal elections in France and Germany. They are the 2 biggest economic contributing members of the Eurozone. In fact, those 2 countries alone out of the 28 countries that make up the Eurozone, those 2 countries contribute about 50% or half of the entire GDP of the European Eurozone. And those, sorry, the European Union is 28 countries, the Eurozone is 18 countries, and they make up half of those 18 countries in terms of GDP that have the euro as their currency. My apologies there. But these are two significant contributing countries that have huge influence on the Eurozone, on the European Union, on the euro currency, and so obviously leadership is up for an election in both of those countries, and we'll see how it will unfold. Now, with respect to Brexit, I believe there's even a speech this morning by the Prime Minister as to how things could unravel here. They haven't even formally asked to leave yet. There has to be some sort of fallout consequences for doing so. We haven't seen them yet because, again, the whole process hasn't even started and will take at least 2 years. What is interesting is stock markets are doing well because the pound has gone so low, but the pound has gone so low because there's less confidence in the UK economy because traders just simply don't know where it's headed and what end agreements they will end up with the European Union once they actually do leave that group of 28 countries. So way too many question marks around that part of the world, and that's why the pound has come under significant pressure, and that's why, quite frankly, if you're planning your holidays right now, London actually is a pretty cheap place to go to, historically speaking. I've already mentioned the fact that you have some big elections coming up here, and you know, Frank mentioned the fact that we had some interesting elections last year where things happened that we didn't expect to happen, so now we wonder, will that repeat itself over in Europe? It's hard to say at this stage, but anything is possible. And as I also mentioned at the beginning of this presentation, there will be a greater emphasis or desire to see increased fiscal spending likely in both countries. Germany maybe not as much, but certainly France, and we'll see how the leaders of the various parties respond to that on their election platform. So still a big question mark hanging over the European Union from a political standpoint, and then that does feed into monetary policy and economics as well.
So it's safe to say there's going to potentially be more volatility within those European markets or international markets this year with all that political uncertainty then, Gareth?
I would say, well, it will depend. I think the volatility goes up if the Eurosceptics get more attention. So, for example, Marine Le Pen is viewed as the Trump of France. The Nationalist Front, which is a right-wing party in France, if it looks as though there might be a showdown between her and the more Republican candidate for the presidency. Of course, they have a presidential system, and they have a first round of elections, and then the top two people then fight off in a second round of elections. If there's any hint that she could possibly win the presidency, then yes, volatility is going to increase. But if the opposite is true, even if she makes it to the last two, but everyone says, look, the other guy's got it wrapped up, you probably won't see as much volatility. So it depends on whether these Eurosceptic parties really do gain traction in the polls and become very competitive. If that happens, then volatility goes up. If it doesn't, then it could be business as usual. Canada, I'll just mention a couple of things here. I'd mentioned earlier it could be a neutral year, and I don't want to get overly optimistic on Canada. Some people say, look, if the U.S. is doing well, shouldn't we follow suit? Especially if they're going to put a ton of money into their economy, don't we get some sort of benefit from that? And yeah, that's true. But here at home, we do have a few things that we need to contend with. So I think I've mentioned in previous presentations I've been concerned about private investment, and this has a lot to do with the fact that with oil prices as low as they have been, companies have been reducing investment in the oil and gas sector by billions and billions of dollars, up to about $40 to $50 billion over the past 2 years. That's a big chunk of money that really would stimulate the Canadian economy. It's not there anymore, and it is to some degree slowly coming back now that oil prices have stabilized to a degree. But at the same time, you need to see more private investment come into this country. There are some that believe that all this fiscal stimulus spending from the Trudeau government will make up for the shortfall in private investment. That is not the case. He's spending up to $30 billion, and as I said, these investment shortfalls just in oil and gas alone is about 40 to 50 billion, and that 30 billion that Trudeau is spending isn't all on fiscal stimulus, not all on infrastructure, it's not all on roads and bridges. It's other social programs, it's children's tax benefit, it's a whole bunch of other stuff. So the federal government will not come in, swoop in, and save the day for us. We need to attract more business to this country, and obviously diversify the economy so there isn't such a heavy reliance on oil and gas, so that we aren't as cyclical. It's always a tough challenge to do. We appear to be doing it now by turning more to a services-based economy than a manufacturing-based economy, particularly on the technology front. But it is something that does need to happen, and we do need to see outside dollars come into Canada to help stimulate and create jobs. I've mentioned this, I think, in every presentation I've done, and I will probably keep mentioning this for another couple of years. Consumer debt is a huge problem here. And it's a huge problem not amongst all Canadians. It is a huge problem amongst a smaller portion of Canadians. But they are younger Canadians, and they are Canadians that we will need to spend, quite frankly. As you get older, you tend to spend less. So we're not concerned about the baby boomers. We're not concerned about seniors in Canada. They don't have massive debts. Most of them probably paid off their mortgages. But those between 20 to 40 years old, there are some concerns. They're not widespread amongst all 20 to 40-year-olds. I'm not saying every young person has massive consumer debt, because that's not the case. But those that do, some of them are really heavily indebted. And once interest rates start to go higher in this country over the next few years, there's going to be some serious trouble in terms of paying back that debt. So the Bank of Canada, as I've noted here, I think is very unlikely to act this year and raise rates. They're in no hurry. They like the fact that the loonie is in the mid-70s. They'd be fine with it being lower, quite frankly, to help stimulate growth. They know that higher rates are going to be a problem for a lot of Canadians, so they will be in no rush to raise rates. And for that reason, excuse me, I don't think you'll see an interest rate increase in 2017. 2018 is certainly a possibility. The only way that we see an interest rate increase here is if our economy ends up performing much better than expected. I wouldn't necessarily complain if we see that. I think we would all agree that's a good thing for our country, and you'd almost want to cheer that on. But I'm not overly convinced that that's in the cards for the next 12 months. I'll just mention briefly on oil. Now, you might say, hey, you're talking about stability here, and this chart's all over the place. Well, this goes back to the beginning of 2015. Of course, 2015 was a massively bad year for oil. And, of course, the first couple of months of last year were terrible for oil. But if you look at, let's go back to June of 2016 through to today, you've seen oil prices essentially between 40 and, let's call it, 55 bucks. That's a decent range. And what I like and what the markets like about stability in oil prices is that corporations can at least feel as though they have some consistency in pricing going forward when they set out their capital budgets. If you have a year where you think oil prices could be 20 or 80, which is not in the year that you'd want, it's very hard for you to set out your capital expenditure budget. If you know that oil prices will be somewhere between 40 to 50, it's a lot easier to set those targets and those budgets, and it's a lot easier to go forward with investment. So that's why I think this is a very positive thing for Canada in particular, and for investment in this country, because we have the stability. There's a little bit more vision here, I think, by management teams as to what they're doing with reinvestment, and also with foreign investment that we're trying to attract to this country. So oil prices on the whole, just as a brief side note, last year, of course, there was some moves here by OPEC to cut back on supply to try and get prices higher. I don't believe you're going to see oil prices run away higher this year, mainly because as soon as oil prices inch higher, there's a lot of shut-in production in the United States that will come back online to take advantage of those prices and put prices lower. So I think, if I had to guess where we might be on oil 12 months from now, I wouldn't be surprised if it's not very much different than where we are right now. It could be lower if the Saudis back out of this deal, if they shut it down too quickly and start pumping oil more quickly than expected. That will definitely put downward pressure on oil prices. But anyone expecting the $70, $80 range this year, I think at this stage that is far too premature, and we're not done finishing the supply-demand balance problems that we've been having here for the past couple of years. So just getting away from oil and talking about commodities in general, I usually just like to show these charts because it really does explain the performance of the TSX. TSX in 2015 was awful, and that's because commodities were awful and just like really bad, all of them. Last year, almost all of them were up. The ones that weren't, and at least in these charts here, were agricultural, which don't have as great an influence overall in the stock market or the Canadian economy. But as you can see, crude, natural gas, a lot of the base metals, and even the precious metals bounced back last year. There was a low, obviously, back in February on energy. We saw a significant bounce back, recognizing that a lot of these commodities were oversold, and that's brought a little bit of faith back to the Canadian marketplace, because we are heavily weighted towards materials and energy, whether you like it or not. That is just the way the Canadian marketplace is. Companies from all over the world that are energy and material related come to Toronto to list because they know there's a market here, or that people look to the TSX market as the place to put their dollars when it comes to those two sectors. Admittedly, the financials held up very well, which is a very good thing since they're weighted about a third of the index of the Canadian banks and the lifecos. They had a very good year. And as such, you put those two things together of good financials plus good commodities, and you get what ended up being one of the best returns in the Western world for the TSX, following one of the worst returns, quite frankly, in 2015. Very sensitive to commodity prices and will be going forward, but hopefully with some stability in commodity prices, we'll get some stability in the TSX. And my last slide here today, as usual, is the Canadian dollar. So looking forward to the dollar, there's two things that we tend to focus on in terms of trying to provide some sort of forecast in currency, which is usually one of the hardest things to do in the capital markets. But it's usually interest rates and commodity prices that tend to influence the Canadian dollar. So on the commodity price front, or the oil price in particular, I've just said I'm not expecting a huge move on oil prices higher. As such, I think the Canadian dollar does not get a huge uplift from commodities. I could be wrong. The global economy could accelerate more than we expect. The impact of U.S. policies, of the new Trump policies, could be better than expected or longer than expected. And there could be follow-on effects globally, could help out Canada. So just based on current expectations, though, I think it's safe to say that oil prices will not accelerate materially in the near term, and as such, I don't think it's going to impact the currency as much, perhaps, as it has. As you can see, if you were to put the price of oil over top of this chart, it would look very similar because, well, this chart is falling just as much as oil prices were falling in 2014 and 2015. So if we turn to interest rates, there's no secret here that the Fed, or the Federal Reserve in the United States, is raising rates, and there's no secret that the Bank of Canada has not been raising rates. And usually when you raise your rates, or when your rates are higher, your currency becomes more attractive. Your currency tends to appreciate, as opposed to those countries that cut rates when your currency depreciates. So if you say the Americans are raising and the Canadians are not, your conclusion would be, well, the American dollar should appreciate against the Canadian dollar. This is all true. Now, with that said, this is something that's been known in the markets for a very long time. We have known for a very long time that the Americans were at some point going to raise rates, and we have known for a very long time that the Bank of Canada was very unlikely to raise rates. So for those of you thinking that when they raise rates again in the States that the Canadian dollar is just going to plummet, I would argue that's incorrect, in that I think it's already priced into the market. And as an example, look at the Canadian dollar going from April of last year to January. It really has only moved a few cents. And yet, there's been a substantial amount of talk about the Americans raising rates. So I think a lot of this is predominantly priced in. If there is a bias for me, it is that the Canadian dollar could end up being a little bit lower, and that could be because the Federal Reserve ends up raising rates more than expected. But those are your levers. I actually think the loonie is not going to be too far off where we are today over the next 6 months, and that's as far as I go. I don't think it's so hard to go out a year on currency because there's just way too many things that impact currency, and it's really hard to predict how they all interact together. But over the next 6 months, I'm not looking for wild swings in the loonie, because I'm not really looking for wild swings in commodity prices, and because I think the interest rate situation is already priced into the market at this stage. So with that said, it is possible, again, that if I'm wrong on commodity prices and they go way up, then the loonie is going to follow suit. And I could be wrong, again, if commodity prices plunge, the loonie can go lower. And if the Federal Reserve raises more than expected, the Canadian dollar could go lower as well. But for now, I'm going to take a pretty neutral stance on the loonie for the next 6 months. So with that, I will turn things back over to Frank to conclude the call.
Great. Thanks, Gareth. So in summary, basically what we should expect is that oil prices should stabilize. And with that in mind, the loonie should experience less volatility this year than it did in 2016. We should anticipate that there's going to possibly be 2 rate increases in the U.S. for 2017. And let's see if President Trump delivers what he is promising. And we're going to keep an eye out for what happens in Europe and the election results in Germany and France. And let's see what the real fallout, if any, is on the whole Brexit situation. So, you know, that's kind of the summary and what to look out for 2017. So thanks, Gareth, as always, for your time and insights. And I want to, again, wish everyone a happy and prosperous 2017. I look forward to seeing everyone throughout the year. And most importantly, on behalf of the Ortencio Group, thank you for your ongoing trust. Have a great day.